class had a sub who taught them it the wrong way. So hopefully, things are better for us. She taught them using the periodic system instead of the perpetual system. So under that, you wait till the very end to cost out. And so it can cause serious problems filling in those forms if you're trying to do that. So remember that you've got all of chapter 5 and 6, every single one of those assignments is open, the concept clips, the tell me mores, everything's open until the 22nd, so Sunday at 11:55, and then we'll restart again on chapter 7 on Tuesdays, so we'll be right on schedule, and then you all got hundreds on your exams. Isn't that great? Good old Jed somewhere, he's driving around. Poor brother. Vegas is, everybody's full. All of the funeral homes are full, so they keep moving him around. So we're not exactly sure where he's at, but I figure, well, maybe he's having a good time. You know, we can hope. All right, so I'm going to put this up here on the board. So all the problems are on the board. Let me turn off the light for you guys. I'm going to do the journal entries just on the board. We don't have to use the journal sheet like we had to use with the other one. And remember that the major difference that we're talking about with these companies is that they have inventory, right? So that's our, can you guys see that? Is that good? So they have inventory, and so we have to take care of that cost of goods sold, and we have to make those changes. And what we deal with in this textbook, because the 99% of companies are dealing with this, we deal with the perpetual inventory system. And that's because scanner systems let us update things immediately in computerized accounting systems. If you had to do it by hand, it would be a whole lot harder to do. But since we don't have to do it by hand, and it's so automatically, what happens if you go to Target or even if you go to 7-Eleven and they scan something, it records the sale, it records the cost of the sale, it takes the item out of inventory. If you're a company like Walmart or Target, it actually keeps track of what inventory you have on hand. And then at the end of the day, Walmart sends out a list of inventory items that they need to their distribution centers, and then they're automatically sent inventory so they can restock their shelves without having to do any of that. But we have to learn how to do all of this by hand so you understand if your system goes down. So there's a couple things we're going to talk about here. There's a couple of new things. I know we talked for a minute. Whenever we record sales with merchandise, so with merchandise entries for perpetual. Every time we have a sale, we have 2 entries. So each sale, we record the sale. So that journal entry is going to be either a debit to accounts receivable or cash, and then a credit to sales. Because when we're using inventory, sales is the revenue account that we use. So that's a little different than fees earned. How do I treat Visa sales? So if my customer pays with their Visa, how do I treat that? Not accounts receivable, that's what it would seem it would be, right? But actually, Visa sales are considered cash because they pay so quickly, so we consider those cash sales. So that's the first one, and this is for the amount of the sale. And then the second journal entry, we have to remove the item from inventory and record cost of goods sold. Remove inventory and record cost. And so what that journal entry always looks like is cost of goods sold, which again, I'm going to always abbreviate now as what? COGS. Okay. So cost of goods sold is always going to be listed as COGS from now on. And then we're going to debit inventory. And when I debit inventory, what does that do to that account? Inventory is what kind of an account? It's an asset account, right? So when I credit inventory, I'm reducing it. So I'm taking that item out of inventory. And cost of goods sold, what kind of an account is that? It's kind of a new one for us. What do you think? It doesn't have expense in it, but it's an expense account, and it's actually the largest expense account that we have. So remember when I showed you what the income statement normally now is gonna look like? It's gonna be sales, less cost of goods sold. That's gonna give us gross profit. And then we have all of our other operating expenses. And then we end up with operating income. And operating income is something that we want our creditors and our investors to look at, because this is everything that we have control over. We have control over our cost of goods sold. We do have some control over our operating expenses. So if we need to make changes, what if we want to increase our net income? We can increase the price of our items, or we can decrease the cost of our expenses, right? But we have to be careful, right? Because if we buy cheaper goods or cheaper materials, what might happen then is we might not have a superior product anymore, and then customers don't want to purchase those from us. And then when we look at some of the larger income statements later in the semester, what you see next is income tax expense. So sometimes you'll see operating income or income before income tax. Why do you think corporations want to have that income tax expense separate? Why would they want that? And why wouldn't they just add that into operating expenses and we let it go? Yeah.
So they look better to investors?
Yeah, well, right, because really corporations, they don't have any control over that income tax expense. They have to follow the income tax rules. I mean, there's lobbyists and they work really hard, and there's a whole lot of deductions for corporations so that they can save money. But this is an expense that they can't really control. They can't do anything about it. And so they want to keep that separate so that when investors and creditors are looking at things, then they can see, okay, well, this is what they're actually bringing in that they can control. They have no control over this, and so they want to keep that separated out. Also, later in the semester, we'll talk about other income and other expenses that you'll see that we also keep separate from operating income. So like when we have all these natural disasters, right? We have the fires in Northern California, we've had the hurricanes, all the issues in Puerto Rico. All of those problems are gonna cause other income and other expenses on income statements. So other expenses might be what? We lose all of our inventory. Other income we might have, insurance payments. We have to record that as kind of an income when we have that crossed out. We want to show that separately so that the investors and creditors can see what we're actually working on as opposed to what we don't have any control over. So that's what, in a nutshell, what the income statements will look like. This is what we're going to deal with when we're doing the journal entries today. This inventory amount that you're going to use, you can calculate it using FIFO, LIFO, weighted average, or you can use the specific identifications. So if it's a house, you're going to have to know the actual price of the house. A couple of things before we get started. They do talk about sales discounts. I'm going to put the first one up there when they've got it like this. They do 210 net EOM, okay? So you read this 210 and end of month is what it means. So it means if you pay within 10 days of the invoice, you can have a 2% discount. So you get a 2% discount if pay within 10 days. Of the invoice date. If not, you pay the full amount at the end of the month. Why do we have that? I don't want to have to give away 2%. What does it encourage my customers to do? It encourages them to pay, right? Because the longer it takes for them to pay, the less chance I have that I'm actually gonna receive anything. And you can see ones, you can have them, I've seen ones where you've got like, if you pay 5 in 5 days, 4 in 10, 3 in 15, and then net, they might do like this in 60 days, okay? So that means they're gonna give you 5% off if you pay in 5 days, 4% off if you pay between 6 and 10, 3% off if you pay between 11 and 15, and if not, you need to pay the full thing within 60 days. So we call these sales discount, we call these discounts, purchase discounts, sales discounts. And then your textbook also talks about something called trade discounts. And a trade discount is just a percentage right off the top. So I think it's either in this problem or the next one they tell us. Probably in the next one. They'll say, oh, it was 15,000, but you got a 25% trade discount, so you start with that at the beginning. And then what happens is that you continue, and then you take off the other amount that was there. Additionally, we have two terms that they talked about. They talked about something called FOB, which means free on board. So you can have FOB shipping point. Or you can have FOB destination. And this is important because it's not only an extra cost, right? So freight costs, we pass that along to our customers, right? So that becomes part of inventory costs, and that we're gonna pass that along to our customers. That's gonna be included in our selling price. So if you purchase something, if you're purchasing inventory and it's free on board shipping point, that means that you as the purchaser, you take title at the place they ship it from. So if anything happens to those goods from the place they take off at the warehouse until they get to you, if they fall off the truck, anything like that, you're responsible to have it insured. You're responsible if there's any loss. If it's FOB destination, that means that the buyer is taking the risk that something could happen to the items on the way till they reach destination, and title doesn't pass until that point. A lot of it depends upon the companies themselves, right, and the industry standard. You might have one industry that uses FOB shipping point, you might have another industry that uses FOB destination. Also, you'll see the same thing. Certain companies don't have trade discounts. Certain industries don't do trade discounts. Most companies will do these sales discounts here, these invoice discounts, because we call most accounts receivable trade accounts receivables, which means there's no formal agreement, right? I call up, I order, and they pay within 30, 60, 90, 180 days. That's just how it is. And then what happens if you don't pay? Well, then I have to go to court, right? But I don't have anything written down. So we'll learn a little later how we try to deal with that if people don't pay us in a timely manner. But, you know, a lot of the risk is on the seller here, that the buyer is going to pay us back. And the hope is that they pay us back because they want to keep buying inventory from us. And in 2008, when we had so many problems with the bank financial problems, what we saw happen was that banks stopped loaning short-term loans, 90-day loans, 120-day loans that small businesses used to keep their companies going by the time, so they could purchase inventory and pay for their employees and pay their bills. And then the next time, you know, they would take this loan out until they needed to repurchase again. So we saw a lot of small business owners go out of business during that period of time. So I think that's the majority of the new terms we got in this question? In this chapter. As we go through these problems, if you have other questions, just let me know. The homework problems are all just doing journal entries. Put these guys here just so you can see them as we go. Is it too dark in here, or is it okay? Alright, so I got this a little bigger. Make sure I'm looking at the right one with the right amount. All right, so we've got all this list of transactions. This company uses a perpetual inventory system. That means they update things after every sale and after every purchase rather than waiting until the end of the day or the end of the week or at the end of the month. So we have a bunch of transactions for October and they want us to journalize them. So we're gonna journalize them. If you wanna pull out your calculator so you can see, I'll show you how to calculate out the amounts. And I'll show you how we're gonna record them, but a lot of times it helps if you've worked it out on your calculator as you go. Because these systems won't go away when we're dealing with chapter 7, 8, and 9, which are on the next test. We'll still have to deal with some of these issues. All right, so on October 1st, our company here, they purchased merchandise from UK Imports Company. That was $14,448, terms FOB destination, net 30. So do they have a discount? No, right? So a lot of times if you don't have a discount, you don't have any incentive to do what? What are you gonna do with your money? You do something else with it, right? You're gonna wait that 30 days. So that's something else that's taken into account when you don't offer discounts, but sometimes you also have customers that don't pay. And so when that's the case, a lot of times we won't offer them any discounts because we just want them to pay. So on October 1st, the company purchased items. What would they record those as? They're purchasing those items to do what with them?
Sell.
To sell them. So what's it called?
Cost of goods.
Not yet.
Inventory.
Inventory.
That's fine then.
That's, so we're gonna, on 10-1, we're gonna debit inventory. Remember, that's an asset account, so we're gonna show that on our balance sheet. And it's the full amount, $14,448. And then we purchased it on account, so it's an accounts payable. And you're gonna start seeing now that we're gonna start indicating the companies that we owe money to. Because that's more realistic, right? We can't just have accounts payable and not know who we owe it to. It makes it harder to figure out things that are going on, and in reality, this is how it goes. So what we call, yes?
For FOB destination, the buyer is responsible or the seller?
Yeah, the buyer's gonna pay for it until it gets there. So the buyer, the seller is the one that keeps title on it until it reaches destination. And so it's due by the end of the month. So that's all that the car company has to do on that date. Bless you. And this is, I should put the problem, this is problem 5-1A. And again, these are down, these are shown now as practice problems on CNOW too. So that's an easy one. Now they're gonna make it a little harder for us. On October 3rd, they purchased merchandise from Hoagie Company for $9,950. Terms FOB shipping point, 210 net EOM, which means if they pay within 10 days, how much of a discount do they get?
2%.
They get a 2% discount. And then they prepaid freight of $220 was added to the invoice. So the journal, the accounts themselves aren't the problem. We're gonna debit inventory again, and we're gonna credit AP to Hoagie this time. But now it's the amounts that we have to calculate out. So the original amount was $9,950, correct? The assumption is that we're gonna record it, the assumption that we make is that we're gonna take that discount. So when we calculate out the amount to record, we're gonna take the 9,950, multiply it times 0.98, which gives us our 98% of that. And then we need to add the 220 to that was put on there for the freight. So we don't get any discounts on freight. It would be nice if we did, but we don't get any discounts on that. So the amount that works out to is $9,971. So that's the amount we're gonna put for inventory, and that's the amount that we're gonna owe on that accounts payable. And remember again, if we're using FIFO, if we're using LIFO, we have to keep track of each one of these individual items and what it is that we're actually purchasing. So questions on this, questions on how I got this amount, why we did it this way. I'll tell you, it makes life easier because your other choices, most companies will take these discounts. If the company chooses not to, they can decide just to put the full amount on. But if they know they're gonna take that discount and we don't record it this way, that means we have to add extra accounts on and extra journal entries. So it just makes life more difficult. So this is actually a much better way to do it. So questions where we're at there? So now we're at 10-4. 10-4, we purchased merchandise from Taco Company, $13,650 FOB destination, 210 net 30. So somebody tell me what 98% of 13,650 is.
$13,377.
Yes. So that's the amount we're gonna record, 13,377. And again, that is, what was the original amount, 13,650? Times 98%. Now, when we're dealing with cells, sometimes we'll do it a little differently too. So when we do the second problem, you'll see things different. Now, sometimes we purchase inventory and we don't like it. There's something wrong with it, it's broken, it's defective, it wasn't what we wanted. So what we see happening here on the 6th is they tell us that they issued a debit memorandum to Taco Company for $4,550 of merchandise returned on purchase from October 4th. But $4,550 is 100%. I recorded it at what amount? 98%. So I need to know what 98% of the 4,550 is.
4,459.
Yes, thank you. So we did the debt memorandum. We sent the money back to Taco Company. So we're going to reduce our accounts payable account by the $4,459. And then I'm going to also take those items out of inventory because I no longer have them in inventory. And now when I actually get my payment, or I actually make my payment to Taco, what amounts do I have to look at? Do I have to take into account? Because I originally owed them $13,377, but I returned the $4,459. So when I actually make payment to Taco, I need to take that return into account when I send them off final payment. Does that make sense? Huh?
Can you repeat the last part you said?
Right, so what happens when we actually pay Taco off, we'll take this $13,377 and subtract this $4,459 that we already sent back to them. So we wouldn't want to pay them the full $13,377 because we sent part of it back. Wrong date, right?
13.
10/13. All right, on 10/13, we paid Hoagie Company for the invoice of October 3rd. October 3rd, Hoagie Company, $9,971. It's in within 10 days, right? So I can take that discount. And so the journal entry is one we've done before over the whole semester. We're gonna debit Hoagie's accounts payable because we don't owe them the money anymore for the $99.71. And of course, I paid it with what? Cash, so I'm gonna credit cash for $99.71. So on 10/14, we're finally getting around to pay Taco. We paid Taco Company for the invoice of October 4th, less the debit memo of October 6th. It's the 14th, they've paid within the 10 days, so they're allowed to take their discount period. And so, and I'll put up how I got the math, but we're gonna debit the accounts payable for Taco. And the amount comes to 89,108, which I got by taking the 13,377, which was the original one from the 4th, and subtracting the 4459. So that's just the amount that I owed him, so that's all I'm having to pay him for. And then I'm gonna credit cash for 8918. I'm gonna put this up some since we're here, but we're at the 19th now, right? Alright, so on the 19th, we purchased merchandise from the, no we didn't. On the 19th, we purchased merchandise from Veggie Company for $27,300. Terms FOB shipping point, net end of month. So we don't have any kind of a discount that they're offering us. So what account am I gonna debit? I'm gonna, inventory for what amount? $27,300, and I'm gonna credit
Accounts payable,
to who?
veggie.
Veggie. For $27,300. Looks like we had a second transaction on 10/19 as well. We paid freight of $400 on the October 19th purchase from Veggie Company. So we saw that the purchase from, when we purchased from Veggie, the terms were FOB shipping point. So as the buyer, we had to take control of those, so we paid the freight separately. So we didn't put it on our, we didn't just add it to the invoice. They were like, Veggie was like, forget it, we don't wanna pay your freight for you, so you gotta pay it yourself. We're still gonna increase inventory by that amount, because we're gonna pass that $400 along to our customers. But we paid it cash, so we just debit cash for $400. Then on 10/20, we purchased merchandise from the Caesar Salad Company for $22,000, terms FOB destination 110 net 30. So if I pay within 10 days, how much can I take off? I can take off 1%, which means I need to record it. What percentage of that amount? 99%. So 99% of $22,000 is how much?
21,780.
21,780, thank you, 2,001,780. And I'm going to debit accounts payable Caesar, which I always spell wrong, but I think I got it right this time, for $21,780. And then they make it really easy for us after this. These last three ones go really easy. On 10/30, they paid us off. So Caesar paid us off, so what's my journal entry for that?
Accounts payable for Caesar, then credit cash.
Yep. Accounts payable Caesar for the $21,780. I'm gonna credit cash for the $21,780. All right, now on 10/31, we paid that, they told us that we paid UK imports for the invoice on October 1st. Remember that on October 1st, we didn't get a deal, right? So this was the amount. So that's the amount that we're gonna pay. So on 10/31, we've got our AP accounts payable for UK of 14,448 and cash of 14,448. And then on the last one that we have on 10/31, they tell us that we paid Veggie Company for the invoice on 10/19. And how much did do we owe Veggie Company?
27,300.
$27,300. AP Veggie Company, $27,300. And we credit cash, $27,300. So there's a couple of things that it's important to remember when you're looking at these, right? We don't know what kind of inventory we've purchased. They didn't tell us, they just told us they bought stuff. But they didn't tell us which ones, so we would have to figure out, in a normal system, we'd have to know which units we had, where we're gonna record those. Do we record them using FIFO, LIFO, or weighted average? All of those items would have to go into that as we work through, the information together. So both chapter 5 and 6 work together. So you would still do your journal entries this way, but when we're gonna do some cost of goods sold journal entries next, and that's where we'll come across some of those other ones. So questions on this problem? Pretty easy? I know you guys did the I know you guys did your PowerPoints, because I looked. So you guys all did a good job. I appreciate that. Make sure they're right. Can you believe this? I'm like the oldest person on the planet, and this is how big it printed it up for me. Like, I'm in my office going, what? All right, questions on this before I erase it? Whose perspective were these journal entries from? The purchaser or the seller? What? All we were recording, right, was purchases, right? So we were just looking at purchases of inventory. When we're looking at this next one, we're gonna look at the sale and purchase of inventory. Were these chapters easier than chapter 4 and 3? No? Are they better now, kind of?
Yeah.
Okay, good. At least you're not having to learn the whole function behind all the journal entries and everything again, so. All right. So for this one, this is 5-2A, so you're doing 5-1B on your homework and 5-2B. And if we have time, we'll do some of 5-3A. But this one, we're gonna do sales-related transactions using a perpetual inventory system. They tell us that the following transactions were completed by Amsterdam Supply Company, which sells office supplies primarily to wholesalers and occasionally to retail customers. Also note that the company uses a clearinghouse to take care of all bank as well as non-bank credit cards used by its customers. And that means that we're gonna use cash when we record those journal entries. And this is on page, they say it's on page 10 of the journal, but we're just gonna do it all on the board. So the only thing they want us to do for this problem is journalize the entries and record the transactions, refer to the chart of the accounts. I'll use them up there and I'll put them up there for you. We'll go over each item and you can see how these work. All right, so remember, when we sell merchandise, we have 2 journal entries. We have to record the actual sale, and then we have to record the cost of the sale and remove the inventory from our asset account. So they tell us on March 2nd that they sold merchandise on account to Equinox Company for $18,900, terms FOB destination. 110 net 30 is the terms they're giving. And then the cost of goods sold was $13,300. Under the perpetual inventory system, we are going to record the sales amount under the assumption that the customer is going to take that sales discount. So it's just like we recorded the inventory. So on 3-2, do I have 2 journal entries or 1? The trick here is you've got 2 different amounts. You've got 2 different amounts, and you've got 2 different journal entries you have to do. So the first one we're gonna do, we sold it to them on account, so we're gonna debit that account's receivable. Again, we're gonna use the name of the company for Equinox. And the amounts we sold was $18,900, but I'm only gonna record how much of that? 99%, so can someone tell me 99% of 18,900? Thank you. 18,711. I thought I did it right, but then I wrote out here at 98%, so I just wanted to make sure I wasn't wrong. So, accounts receivable, Equinox owes us $18,711 so long as they pay within the discount period. If they don't pay within the discount period, so let's say they pay us on the 13th, then they have to pay us the full $18,900. And then we're gonna recognize the revenue from this, so we're gonna credit sales for $18,711. And the nice thing about cost of goods sold is the problem's giving us that cost for that. So on the second journal entry, it's also on the second. We're gonna debit cost of goods sold for $13,300. And then we're gonna remove those items from inventory of $13,300. And this amount here, this $13,300 would be used using LIFO, FIFO, weighted average, or specific identification, whichever one the company was using. And so every time we have a sale, we're gonna have to do those two journal entries. Additionally, this chapter introduced the concept of collecting sales tax. So it says here on the 3rd that we sold merchandise for $11,350 plus 6% sales tax to retail cash customers. The cost of goods sold was $7,000. So am I allowed to include sales tax that I collect in my total sales? No, because what do I have to do with that sales tax? I have to send it to whoever the taxing authority is. But the full amount of cash is gonna involve all the cash that I'm gonna collect it's gonna be the 11,350, right? 350 times, if you do 1.06, that gives you 106% of it. And so that total that you got, that you're gonna debit to cash is $12,031. But the amount that I'm gonna credit to sales is how much? $11,350. And I've collected this sales tax and I owe it to the taxing authority, so it creates a liability for me. So I've got sales tax payable of the difference. Of $681. So you can do it any way you want. Sometimes students would just rather take the full sale amount and multiply it by the sales tax percentage. You could do it either way, it's gonna work the same way. Am I finished with this transaction now? What do I have to do? I still have to do my cost of goods sold and the inventory. So I've also got to debit cost of goods sold for $7,000. I credit and take the items out of inventory for $7,000. So questions so far where we're at? Alright, so on the 4th, we sold merchandise on account to Empire Company for $55,400, terms FOB shipping point. That means that the people who bought it from us, they have to deal with that. The full amount's due at the end of the month and the cost of goods sold was $33,200. So what's my first journal entry? What am I gonna debit? Accounts receivable to Empire. For how much? $55,400, and I'm gonna credit sales for $55,400. And then I'm gonna do the cost of goods sold. And the cost of goods sold was 33,200. I'm gonna take those items out of inventory for 33,200. Alright, so 2, 4, 5 left. I want you guys to work on ones for the 5th, the 12th, the 14th, and the 16th. Take 5 minutes and then we'll do the rest of those on the board, but work with each other and calculate out the amounts. And it's always easier, it's always better, I think you guys do those together and can kind of work them out a little bit. So you're gonna do the ones for the 5th. You'll do the ones for the 12th, 14th, and 16th. You're supposed to talk to each other.
So the 5th is 30,000.
And if you haven't already done your homework for chapter 5, the third problem is a combination of these two where you're doing purchase and sales transactions. They've just put them all in another problem.
Sales 3,000 and sales tax bill.
Yeah, which I got 1,800, so it's like 31,800. Then like underneath that, sales is 30,000, and then sales tax. Right, so I think it says cash here at the very top. Yeah, cash, and that was like the 31,800.
So you cash in and debit account costs receivable.
1,800.
Yeah.
Bring me
And then
in.
it's sales, that one is sales for 30,000.
Yeah, because if you want to shrink what you are, yeah, credit that, and then I think that's for sale. Yeah, no cash. I'm just gonna go cash.
Well, that's no good, so we're never gonna know.
Cost of goods sold was 19,000.
Yeah, the full 18 cell.
Does anyone want to come up here and put up the journal entry for the 5th? You get to use the magic,
Well, you get the 6%.
So on the 5th, they sold merchandise for 30,000 plus 6% sales tax to customers who use MasterCard, and the cost of goods sold was $19,400, right?
So it's like, it's 16 if you take one.
Good.
And then, what were you gonna say? The second one means if they don't take the discount, they have to pay for the discount. So, yeah. I think just pay attention to like the problems, because they don't really have anything where like, you have to go back because they didn't pay it in a few times, so just focus on the first one. Yeah.
All right, good job. Did everybody get that? So So remember, cause it was a MasterCard sale, was it MasterCard they said?
Yeah.
We treat that as cash because they put that money right into our bank account almost immediately. They do charge us a fee, but we count it as cash. So this was the full amount plus the 6% sales tax? Yes.
Or I guess after the expense.
Sure, and then, so the sales were 30,000, the tax, the 6%, is it 6% sales tax, I think? 6% of 30,000 is 1,800. So we debited cash for the full amount, credited sales for 30,000, credited the liability sales tax payable for 1,800. And then we still had to keep track of the cost of goods sold for 19,400, so we debited that expense account and we credited inventory for 19,400. Yes.
How come some like restaurants and stuff that you go to, they don't accept American Express?
Because American Express charges more, and so does Discover Card.
Okay.
So they charge more, and so that's why a lot of places don't use them. And that's why a lot of times, like, I know at my, nail salon and my hair salon, they charge me if I use debit, they charge me like 50 cents. And it's because they're charged per transaction. So every time that they pay the $40 or $50 a month, especially if they're an independent contractor that's working, they still have to pay that 40 or 50 cents a person. So sometimes you'll even see places where they're like, we don't take any debit cards at all. Everything has to be in cash. But yeah, typically Visa and MasterCard charge between 2 and 3%. They charge less for debit card transactions than they do for credit card transactions. Anybody know why? Because you can choose on your debit card. What do you get if you choose Visa instead of debit? Let's say you're gonna purchase $6,000 TV.
You can cash back the rewards and stuff.
You don't get cash back, but what does Visa give you?
I get like credit back towards my credit card.
Okay, so you get credit card points. There's something else that you get, protection-wise. You get more of a protection on a warranty, a lot of times if you use the Visa, rather than if you just use the debit. Because it says Visa will give you a fair amount. So if there's a problem with the transaction, let's say you get the television home and it's no good and you've purchased it using your Visa card, you're much more likely to have your bank refund that money for you immediately than if you use the debit card.
Yeah.
So, and you get points and you get things like that too. But yeah, and almost everybody uses Visa and MasterCard. So Visa and MasterCard can charge what they want, but last I heard, American Express charges 5 or 6%. And that really adds up when you think about it. And Discover Card's somewhere in between there.
So do you do anything for this, like, example, do you have to do anything different for the, October, or the March 14th transaction?
No, we're gonna use it as cash.
Okay.
Anyways, that's how they use it, but we probably should be using it better than that, so.
Okay.
But yeah. Our textbook isn't going that far into it, but. Alright, so anybody wanna put the 12th up? Or tell me what to put up for the 12th? On the 12th, it said that they received the check for the amount due from Equinox for the sale on March 2nd. So they're within their discount period. So what did we receive from Equinox? So I'm gonna debit cash for $18,711, and I'm gonna credit what?
Accounts receivable for Equinox.
Accounts receivable for Equinox. And things used to be a lot better, because you used to have to go in and it was a mess when you put everything in at the full amount and then they took the discount, so this is much easier. You're right though, so now that they've got me, the book got me, you would treat, a lot of times, and another thing with American Express, and they may have changed in the last 9 months, but generally speaking, it takes them longer to get the money to you, so it's not necessarily treated like cash, but we're gonna treat it like cash here, because this is what the book says. So on the 14th, we sold merchandise to customers who used American Express cards for $13,700. The cost of goods sold was $8,350. So I'm gonna debit what? I have 2 journal entries. What's my first one? Debit cash for how much?
$13,700.
And credit sales for $13,700. And then what's the second journal entry? Cost of goods sold, so I have COGS for how much? $83.50, and I'm gonna credit inventory for $83.50. There's not, again, this is why they pay us all the big money, all the accountants. On the 16th, they sold merchandise on account to Targhee Company for $27,500, terms FOB shipping point. 110 net 30, so I can get a 1% discount if I pay within 10 days, which means that I'm gonna record this sale at what percentage of the total amount?
99%.
99%, so I'm gonna debit accounts receivable for Targhee. That 99% is 27,225, my math is right. I'm gonna credit sales for 27,225. And then I've got the cost of goods sold for 16,000. And inventory for 16,000. So on the 16th, things are a little, we're at the 18th, right? That's where I'm at. On the 18th, we issued a credit memo for $4,800 to Targhee Company for merchandise returned from the sale on March 16th. So this means that it was Targhee Company that didn't like the merchandise that they sold to us, that we sold to them, so they returned it to us. And the cost of the merchandise returned was $2,900. So we have to make two journal entries. What percentage did we record Targhee's at? 100%, 98%, 99? 99. So when we have this return, we're gonna have to take that into account, and when we have returns, we're gonna have to do two journal entries also. We're gonna have to deal with the one for the sale, and we're gonna have to do the one that's dealing with the inventory being returned. So we have a new account here. We're gonna debit an account called Customer Refund Payable. So it's a payable, which means it's what kind of an account? It's a liability account, but I'm debiting it. So what am I doing? I'm actually reducing it, right? So even though it's a payable, I'm reducing it. I'm gonna debit it, because what I'm gonna do right now is I'm gonna credit Targhee's accounts receivable, and I'm just gonna take it right off their accounts receivable of $47.52. We like to keep the amount of refunds separate so that we can tell if we have a problem with our products, if we're having a problem just necessarily with customers, and that's 99% of the amount that was returned. And then the cost of those items, we're gonna put them back into inventory. And sometimes students are like, why would we put this back into inventory? We have to put it back into inventory first, and then we may find that we're gonna return it to who we purchased it from. So we've got inventory, and then we've got another account called Estimated Inventory Returns. For $2,900. You're gonna see, this is a liability. Liabilities go on the balance sheet. When we're dealing with this estimated inventory returns, a lot of times where we're gonna see this is on the income statement. A lot of times we see net sales and it takes that out, but they still have to report that information on the financial statements and the notes to the financial statements so that we can keep track of those. So questions on those ones? So, and this is listed in your chart of accounts, so when you look in the chart of accounts, you can see those and you can see more there. They've also given, so we've got 6 other journal entries that I want to go over, just so that when you do, if you haven't done that third problem, you will have covered all the different journal entries that you're going to have for the Chapter 5 homework. So on March 19th, we sold merchandise on account to Vista Company for $8,250, terms FOB shipping point 210 net 30. We added $75 to the invoice for prepaid freight. The cost of goods sold was $5,000. So on March 19th, we're gonna debit accounts receivable to Vista, and hopefully somebody has out their calculator, because the original amount was $82.50, right? But we're only gonna record it at how much?
98%.
98%, and then we have to add something else to it,
75,
plus the 75.
8160.
I have 85.
85 before the 75.
Yeah, then you add the 75, it's 8160.
Okay, so, oh, no, so they're gonna have us do it separately, that's why I did it wrong myself, alright, never mind. So, the way I would do it is I would do it all together, but this is how your textbook's having you do it, so this is how you guys have to do it, sorry. So you're gonna actually have 3 journal entries for this. The first one you're gonna have is the 98%, which is the 80, 85, is that right? That amount, okay, and then we're gonna have sales for 8,085. In addition, we're gonna do a separate one for that $75, accounts receivable to Vista for $75, and we're gonna put cash for that. Now, what you could have done is you could do a compound journal entry and it would have been correct. If you'd had the accounts receivable for the full amount of the 8085 plus the 75, you could have then done sales for 8085 and cash for 75, but your textbook had you split that up. And then we've got to do the cost of goods sold for 5,000. And we remove the other items from inventory. 5,000. So that's on the 19th. We'll see how much we can get up here. All right, so that's on the 19th. We've got we're not too many left, and then you guys get to go. On the 26th, we received a check for the amount due from Vista Company from the sale of March 19th. So we look at March 19th, Vista, how much did Vista owe us? Did I miss? I missed Targi, I'm sorry. On the 26th, so how much does Targi owe us? We have this here.
7,000 minus the 4,000.
Minus the 4752, so how much cash is Target gonna send us? How much?
22,503.
I had 22,473.
That's what I have to.
So it's the 27,225 minus the 4752.
Yeah, 22,473.
Okay. But you guys keep me honest, because 326, so we're gonna have the debit to cash, 22,473, and then we're gonna we're gonna credit Target's accounts receivable, because they don't owe us any money anymore, for the 22,473. Thanks you for grabbing me, I'm jumping ahead. So that's for the one from the 26th. On the 28th, they tell us that we received a check from Vista Company for the March 19th transaction. How much is Vista gonna give us? How much does Vista owe us?
8160.
They owe us the 8160 because they owe us both the 8085 and the $75. So on the 21st, we're gonna have cash of 8160. Let me put that here so you guys get it. It's the 8085 plus 75. And then we've got the accounts receivable to Vista that we're gonna credit for 8160. Which is why it probably would have made more sense just to put this into one journal entry rather than to split it up like that. And so if you were working for an accounting company, they would probably have you do that. All right, we're getting down there now. We are We received a check for the amount due from Empire Company from the sale on March 4th. On March 4th, Empire Company purchased $55,400 from us. They didn't have a discount period, they didn't have a discount, so we're just gonna have to debit cash for $55,400. We're gonna credit accounts receivable for Empire. So that takes care of them. I'm gonna run out of board, unfortunately. So that takes care of the 31st. Then on the other thing, on the 31st, we paid Fleetwood Delivery Service $5,600 for merchandise delivered during March to customers under shipping terms FOB destination. So that amount is what to us? Is it an expense? Is it an asset? What do you think it would be? It's an expense. So we're gonna have an account called delivery expense. Which is $5,600, and we paid cash for that. And those are for items that we were selling rather than items that we're purchasing, which then that freight we pass along to our customers. On April 3rd, we paid Citibank $940 for service fees for handling MasterCard and American Express sales during the month of March. What is that amount? That's gonna be an expense. Sorry, I know you guys in the back can't see it. I'm gonna debit credit card expense. And expenses go on which statement? Yes, thank you. So we're gonna have cash of $940, and then we're finally gonna pay the sales tax authority. The sales taxes that we've collected for the months, or so far we've collected for the quarter, probably $6,544. I go over here. For $415. When we collected those sales tax, we debited the account sales tax payable. So we credited sales tax payable, now we're gonna debit sales tax payable for that full amount of $6,544, and we're gonna credit cash for $6,544. And in reality, if you're in some place like California, you're gonna have state income tax, you might have city tax, so you're gonna have numerous other taxes. So, we did 1 and 2, A, 3 is just a combination. So that's also up there if you wanna practice, and if you have any questions, you can email me on those, but we've covered all of that. Yes, question?
So the first drawing we did, that was for, or not the first one, this one,
The
but
first problem.
when we were pretending the problems were us as, yeah, so what is that?
That was more where we were purchasing.
So is there a specific anything for like?
They refer to that as journal entries for purchases under perpetual inventory method. This one is journal entries for sales under a perpetual inventory method, and 3 is sales and purchase journal entries under a perpetual method. So they've just combined the 2 problems together to give you different questions.
Okay, so.
And then we start in earnest on chapter 7 on Tuesday, so make sure that you do your, let me see, I wanna see what, chapter 7's like, 'cause I can't remember off the top of my head. Chapter 7 is internal control and cash, which is interesting. It's an interesting thing that we can talk about. We're gonna talk about cash. We'll deal with, bank reconciliations. But internal control, as more and more things have happened with Las Vegas, we have a lot more relevant material that we can discuss right now involving internal control and internal control failure. So it should be an interesting week on next week for chapter 7. Have a good weekend. Thank you guys. Alright, hopefully you're feeling better.
A little better, yeah.
Yeah, you sound a bit better.